Welcome to the program. The idea of a push-up and sustaining of that, I know you're pulling out data, of course, about those oil rigs, the Baker Hughes numbers. Is that the potential threat that the exuberance runs away with itself and that production comes back online too quickly and offsets the stability of these price moves higher?
Well, good afternoon, Carson, Scott and Ben. Look, a couple of quick things, and exactly right. You know, we're up 9, it's 337 as the Baker McKenzie count, Carson. It's been a good week for them. You know, they're very flexible, as you know, and agile. I think that's really the terminology that needs to be, considered for these drillers and rig counts. So as they become, the price moves to that 50, 51, so on, these guys just enter a market, and it's just been demonstrated over the last matter of months. So where we're going now, we saw a big move Friday night. We saw Asia was up fairly solid today, not a bad number. And taking that into consideration, there's a lot of push there for certainly crude to go higher. We'll just have to wait and see how the week pans out, of course, with Brexit.
Really interesting as well on another geopolitical possibility, the idea that Putin may well be preparing to offload Rosneft, which, when you go to Moscow, you look at the company nameplate and the brass reflects the Kremlin literally in its gaze, which is just such a wonderful metaphor for those links across the Volga to that citadel of power. But we get carried away at our peril with that kind of an observation. Let's just, though, understand whether that might happen. Heaven forbid you actually plump up your coffers by selling a crown jewel. It's like getting rid of the Fabergé eggs, Peter.
Well, it probably is, Carson, in your memorable days in Moscow. That's taken into consideration. Right. Also, very similar play of what Saudi Aramco did. Yeah. So they were selling a portion of the organisation, the same as what Putin's trying to do. He wants to raise about 11 billion for about a 19.5% stake. So, large reserves as far as natural gas, of course, and then crude oil. So Russia is a powerhouse.
And just have a look at the experience of TNK BP, if you needed one acronym to understand how any deal done can transpire to be sort of problematic stage. You'd be well versed in, and maybe going back and looking at the tapes on that one, because it was far from pretty for Mr. Highwood. Let's, though, think as well the connection now with India too, because they could be another bidder. And they've seen a lot of upheaval. You look at that nation with more than passing interest. So your views, Peter, even on demand for crude coming out of that economy, we talk about the hope of growth. Is that hope starting to wane from where you sit?
No, not at all. Okay. I mean, when you think about it, the IMF's numbers, Carson, over the next 3 to 4 years, India is going to be the fastest growing economy. It'll overtake Japan this year as far as crude consumption, so it'll be a number 3 player in the world. All the numbers, everything, they're green lights the whole way across, and they're turning into, the engines are turning on, literally. So, India's got some wonderful years ahead of it, and I think the fund's really starting to, pick up speed.
So, OK, a key henchman's gone, but you say the show will go on and they won't, there's no reverse gear, which is, that's positive, that's encouraging. And
well, they're the IMF, I mean, they've got their numbers and they're certainly taking that on board.
Other factors, too, that you're watching out for. I know Janet Yellen's going to be moving, no doubt, not just sentiment, but in real terms, the dollar. She'll be speaking after Brexit, so the day after the vote. Yeah. What do you believe the dollar trades up to that point now in sort of a range of?
Well, when you look at it against the yen and against the pound, we're at a 2-year high, yen against dollar. The pound's very, very strong as well. It's had a nice move up. I think it's going to just add to the week ahead of us. One thing we need to take into consideration, futures margins for gold, silver and, of course, pound are well up. The exchanges and certainly the brokers are after a higher margin. So that's also some consideration as far as the volatility expected. And when you look at historical volatility, that'll play into all of this. And then you're thinking of what James Bullard from St. Louis is saying, well, you may only see one rate rise in the next 2 or 2.5 years, Carson. So
how much of a threat to liquidity is that? The idea that you're stepping on additional charges now for bullion traders. Do you kind of risk a liquidity strike, or that would be going too far?
Well, not really. I mean, you've got to put your mind back to January of 15 and what happened there with the Swiss franc, and companies and, of course, the providers and the exchanges need to have a healthy margin, and in volatile times people can whipsaw it out within a matter of seconds, so that's why the increase in margin.
It hadn't been necessarily, though, a practice, a widespread one in commodities markets, though I accept that it had been across other asset classes. But
absolutely. But at these times, Carson, we've seen gold have a very heavy uptick, and it's not uncommon in those really volatile times or expected volatile times to increase margin.
Peter, do you think that's a little bit of a lagging indicator, though? Obviously, the exchanges have moved because of volatility. Now that they're putting that margin up, surely that will actually act as a dampener, as it's intended to do. Well,
it might, Ben, but, you've also got to understand the other side of traders are traders, and if they've got to stump up higher cost of doing business, it's just a cost that has to be absorbed. It's just the way, if you want to trade those particular markets, the companies aren't going to have to call on you, 2 days down the track and you've been taken out of play. They want a healthy margin in there to, as far as risk mitigation.
Other commodities that you've got your eye on, copper has been moving on some other Fed remarks, but also some of the fundamental data looks relatively rosy now, well supplied the market for the next few months. So that would, if anything, though, imply a little bit of price weakness, would it not?
Well, it will, and I mean, when you look at copper, it's still languishing, Carson. It's still doing fairly poorly. If you put your mind across to zinc, so that's another market, it's up 25 or 26% year to date. And the copper market's as flat as a tack. So, there are some base metals that are showing plenty of upside and others that are languishing.
OK, the link as well with hedge funds and then it shorts in COMEX copper, because it's a bit like we were monitoring even on, say, the energy piece and the hedge fund component to that. I mean, this is now the biggest on record, the net short positions in COMEX copper.
Yeah, exactly right. So
what are they
that's not uncommon. When you've seen traders enter markets and they're seeing opportunity and they're piling into it on a short side, very similar to what, the crude market, and they were all long. And then gold's always been long in the last matter of a week or so. So, traders and hedge funds can move into a market very, very quickly. They're highly liquid, they're very volatile, and that's the nature of the trade.
And you've just got to understand, you were talking IMF before, the complicating factor of a hedge fund move into a sector that is so critical to the overall economy, be it the housing piece and the copper input into that one that goes across continents, across major economies. You kind of ignore your peril, really. So IMF makes a call on growth, and then hedge funds can potentially upset that at the moment it's great, it's getting cheaper. Yes. But to the other point, what swings lower can go up a lot higher when they get out.
Well, exactly right. I mean, put your mind back, it was $11,000 a metric tonne. It's just over $4,000 today. So, well, I think it's about 4,200 or 4,300. So that gives you the price, I suppose, scope, and that's only over the last, say, 4 to 5 years.
I wonder how much of that trade now is quite crowded, though, Peter. I mean, we've seen it time and time again, particularly in the currencies over the last 6 months, where the whole market goes in one direction, and then ultimately there's capitulation, and that's the point in which it turns. So, given that we're now at the point where the copper shorts are at their all-time high, the contrarian in me can't help but think now's the time to probably have a look at going long.
Exactly right. I mean, and that's what many traders do. They go against the market, and that's where the big breakouts happen. Markets whipsaw very quickly, Ben, as you know. And that's where profit potential really lies. You've just got to get timing right. We'd all love a crystal ball, but the reality of the matter is you're 100% correct. Though when they happen, and they happen very, and volatility, and this week is a perfect storm, so it's going to be interesting how it plays out.
Well, zinc is the classic, I suppose, swing argument to that one, which has hit those incredible highs, 26% year-to-date gains. That one, though, looks on the knife edge as to whether this is the end of the run. Do you hang on, or do you kind of cut your losses, bag your gains and move on?
Well, there's another...
Bag your profits.
And this just shows us, as far as the trading psyche, you've got shorts as far as copper, yet you've got call options. I think it's around about 2 to 1 versus put options for LME zinc. So that just gives us an idea. All the traders are one way again.
Right. I can't help but, Peter, think along the lithium lines as well. I can't tell you how many phone calls I've had in the last 3 months about where lithium is going over the shorter term. And again, I think you get this crowded trade effect, and it can only carry you so far.
Well, exactly right. We saw that a few years ago as far as rare earths, and we've all seen that. So when trades do go one way, and we've seen shorts get squeezed many, many times, or longs get squeezed, and markets turn. They turn violently, and it's just sometimes a race to the bottom or a race to the top. So you've just got to be... They're hard to guess, markets. That's why the volatility's there, and, of course, the profit potential.
Frankly, Peter, that's why we get paid, right? Scott Phillips here from the Motley Fool.
Scott.
Mate, just a quick one. Obviously, the flip side of that is that booms tend to run longer than you expect them to. When rationality says it's all over, they go and go and go and go and go, and eventually they collapse. How close do you think we are in the lithium space? Is it all over by the shouting now? Is there enough there in the structural demand in the economy? I think we all believe that the prices are run well and truly ahead of the fundamentals, but to some degree, the fundamentals could catch up as quickly as the price could come back, right?
Well, exactly right, Scott. I mean, look, the demand picture, you think about it on the big scale of things, and there's a lot of motor cars out there and a lot of electricity needed, and, of course, new power. So, you know, I look at it over the next 10 to 20 years, and I'm sure that demand is going to be very, very strong. As far as supply is concerned, you only need a hiccup, you only need something, you know, a warehouse or something catches fire, or a production plant goes into some sort of, you know, force majeure. Those things happen, and that's what creates the uncertainty in the market. And, of course, price is, you know, a byproduct of that.
Well, you just wonder whether who will be in next, rather, on this one. Who might come even back from the brink to try and capture some interest. One thinks of Link Energy and all sorts of other weird, wonderful combinations, but they've frankly got their hands full on other matters, as we know. Thank you, Peter, as always.
Thank you, Carson.
Appreciate it.